If you have $1 million, you probably have a financial advisor who put you in a mix of 60% stocks and 40% bonds. It's the standard industry advice. They tell you it's safe, they tell you it's balanced, but that advice is designed for the masses, not for the builders of generational wealth. If you have $100 million, you don't have a financial advisor, you have a family office, and they are playing a completely different game. I can promise you they are not putting your money in a 60-40 portfolio. They left that model behind decades ago. I have spent 30 years managing money, brokering international real estate, and advising family offices. I have been inside the rooms where the biggest deals happen. I have seen exactly how the ultra-wealthy allocate their capital. It's fundamentally different from anything the middle class is ever taught. They don't chase hot stocks, they don't day trade. And they certainly don't rely on traditional mutual funds that charge high fees for average returns. They use a strategy called the Endowment Model. It's the strategy used by institutions to preserve and grow wealth for centuries. Today, I am going to show you exactly how a $100 million family office allocates its capital. We're going to break down the exact percentages. We'll look at the specific asset classes and the philosophy that drives these decisions. This isn't just about numbers, it's about strategy. More importantly, I am going to show you how you can apply this to your own portfolio, even if you're just starting with $100,000. You don't need $100 million to start thinking like a 100 millionaire. You just need the right formula. Let's look at the numbers. For the last 40 years, the financial services industry has sold the public on the 60-40 portfolio. 60% in the S&P 500, 40% in bonds. The theory is simple. When stocks go down, bonds go up, and your portfolio is protected. It worked until it didn't. In 2022, we saw why this model is broken. Inflation spiked, rates rose, and both stocks and bonds crashed together for one of the worst years in history. The 60-40 model relies entirely on public markets and daily liquidity. But family offices know that liquidity has a massive hidden cost. When you buy a stock on the exchange, you're paying a premium for the ability to sell it tomorrow at 2 p.m. But is that what you really need? If you are building generational wealth, you don't need to sell tomorrow. You need to think in terms of 5, 10, or 20 years. Family offices trade that daily liquidity for something far more valuable, the illiquidity premium. They lock up capital for higher returns. This premium is the absolute foundation of the endowment model. It's how they consistently outperform the public markets year after year. This model was pioneered by David Swensen at Yale University. He realized that institutions don't need to behave like retail day traders. A typical $100 million family office portfolio looks nothing like yours. Let's break down the actual percentages they use. Only 30% is in public equities, the stock market. That's your S&P 500, your individual blue chip stocks. That's just 1/3 of the pie. And only 10% is in fixed income or cash. They keep their safe money minimal because they have other ways to protect the portfolio. That leaves 60% of the portfolio. This is the secret sauce. 60% goes directly into alternative assets, the private markets. 20% goes into private equity. These are direct investments into companies before they ever hit the public exchange. This is where the real growth is. Another 20% goes into real estate and hard assets. We're talking direct ownership of apartment complexes, commercial buildings, and raw land. The final 20% goes into venture capital and hedge funds for high upside opportunities and market neutral protection. Why do they do this? First, low correlation. If the stock market crashes tomorrow, your 50-unit building in Florida is still collecting rent. Second, the returns are simply higher. By giving up daily liquidity, family offices capture that massive illiquidity premium. They target 15 to 20%. They aren't betting on the market. They are investing in real assets and private businesses. They are playing a completely different game. Now, you might think you need $100 million for this. You don't. Today, the rules have changed, and you can apply this to a $100,000 portfolio. Step 1. Determine your true liquidity needs. How much cash do you actually need in the next 24 months? That's your cash bucket. Keep it small. Step 2. Allocate your public equities. Use low-cost index funds. Don't try to be a stock-picking genius. Let the market work for you. Step 3. Start building your alternative asset bucket. You don't need to buy the whole apartment building yourself. You can invest $50,000 as a limited partner in a real estate syndication. You get the cash flow and tax benefits without the tenants or toilets. You can invest in private credit funds yielding 9 to 12%, or even buy a small cash-flowing local business. The options are there. The goal is to move away from public market volatility and capture that illiquidity premium. It's the only way to build wealth like an institution. For 30 years, I have helped clients make this transition. It's not about how much money you have, it's about how you think about capital. If you're ready to audit your portfolio and build an endowment model strategy, book a consulting call with me at the link below. Stop investing like the middle class. Start investing like an institution. I'm JM. I'll see you in the next video. This is not financial advice.